Hello everyone, here is Ali Talibi and we are going to learn a new finance lesson. Today we are going to talk about different forms of businesses. This is the second lesson from the first module, Firms and Finance. So what is our topic? What are the topics today? First we'll talk about different form of businesses. So I'm going to introduce you three forms of businesses so you will be able to compare these three types of businesses. Then we'll focus on corporation as a third form of business, and I will talk about some issues which are associated with this form of business. More specifically, we'll talk about double taxation, but also I will provide you some advantages of this form of business, including interest tax shield. Finally, we'll wrap up with a very common issue which you will see in corporation, which is called agency problem. So let's start with the first form of business. As we mentioned the first lesson, you came to the point that you want to have your own firm, your own business. So for sure you need to raise funds, you need to invest the money that you raise. However, the point here is you need to register your company or your business. You have several options. Three of the major or three of the common ones actually are sole proprietorship, partnership, and corporation. So the first common one is you are the only person or you are the only owner of the firm. So what you do, you register your firm as the sole proprietorship. So which is a kind of firm owned by one person and one individual, and that person will be the only liable person for all the firm's obligation. If, for example, something happened to the firm, if you owe money to someone, you will be the only person in charge. So now, after explaining this type of business, for sure, you can see this is a kind of risky situation. Why? Because if you are not able to pay back the money, for example, you got from the bank is able to come after you and take whatever you have. It doesn't matter how much your company or your business worth. If the liability, if the money you owe actually to the bank is greater than the value of the business, they can come after you and they can take your own personal stuff. For example, if you have a house, if you have a car, they can come after those items. So you see, this is a kind of situation maybe you don't like. So you say, you know what, I don't want to risk my own family situation, my own property, my own assets. So you might consider the second form of business, which is called partnership. For example, you are the finance expert. You know all about the money, assets, liabilities, accounting, financial statements. However, your friend is a great web developer. You want just to partner with him or her, and you want to have your own company. So you might consider partnership. So what you do, you go to your friend and say, okay, you know what, let's just go and form a business, a partnership business. So you have the knowledge in web development, software, and I have knowledge regarding the money aspect. So that's a very good combination. So you go with the partnership. The good news is you can share your knowledge, you can share the responsibilities, you can share the liabilities. However, more or less, you have some risks which was associated with the first form of business, sole proprietorship. But the good news here is you have two options. When it comes to partnership, either you can go with the general partnership or you can go with the limited partnership. The general partnership is very similar to sole proprietorship. So if something happened to the company, if you owe money to the bank, they can come after you and they can take your own personal belongings. But the limited one, it is just limited to the company. whatever it was. So they cannot come after you, so which is a kind of good news. And as I mentioned, you can share your knowledge with your friends. So that's the another advantage. But still, similar to the first form of business, the ownership, the management, all are same. If, for example, something happened to your partner, for example, he's going to leave, or God forbid, he or she dies, the partnership is done. It's over. So you might consider the third form of business, which is called corporation. So you want to form a corporation. So why corporation? For sure, it has several advantages. But the major note or the major point regarding corporation is the corporation has its own identity. That's a unique legal entity which has its own features and characteristics. It's like an individual. It has its own name, its own information. So the good thing here is, if, for example, something happened to the owner or one of the owners, if the employees for some reason did leave, still the corporation is there. So if something happened, the corporation is in charge. The corporation can be sued, or it can sue. How it works? Here is the idea. The idea here is, for the corporation, as I mentioned, you're talking about the different legal entity. Now, when the corporation is becoming bigger and bigger, usually it's not very practical to manage and run the business by the owners. So, for example, think about IBM or Google or Yahoo. These are big corporations. So it's kind of very difficult for these companies to run by shareholders, because we know shareholders are the owners of the company. So how it works? So here is the structure of these corporations. So as I mentioned, we have shareholders. So these shareholders are owners of the company. If you have hundreds of shareholders, they don't have time to monitor, to control the everyday business. So what they do, they actually choose a few members for what we call board of directors. So these board of directors, 5 people or 7 people, actually they are controlling or monitoring or managing what's happening in the company. And remember, these directors, these people, these members are supporting the shareholders' interests or benefits. They want to make sure that whatever is happening in the company is in the interest of these shareholders. However, most of the time, these managers or directors, either they don't have enough expertise or they don't have enough time. So what they do, they actually choose someone which is called CEO or Chief Executive Officer. In some countries, it's called Managing Director. So the description is more or less same. So that manager, the CEO, is the person who is actually making the daily basis, day-to-day kind of decisions. So which is a very good thing, because he's the expert in the field, he knows what he's doing, and the shareholders, they don't need to be involved. But it raises a few issues. So this structure raises a few issues. Let me first talk about something which is called agency problem. So the CEO is supposed to be the agent or representative of shareholders. So this person should be in charge of the company and need to make sure he's following the shareholders' interests. However, it's not the case every day. He might consider some own benefits or his or her own interest. He can invest on a project which is actually very good in the short term, but not good in long term. And with the short term, he can make lots of cash, lots of money, and receive lots of bonuses. But in long run, the shareholders are more concerned about the long performance of the company. The outcome may not be as good as it is in the short term. So here you see a conflict of interest is happening between the CEO, which is the manager of the company, and the shareholders, who are the owners of the company. So this conflict of interest is called agency problem. So that's one of the disadvantages of the corporation. Mirza Ali, is there any solution for that? There are several solutions. One of the solutions is to tie the payment of the CEO to his performance. So you can pay your CEO based on the performance. If the performance is good, if the outcome is what shareholders are expecting, so you will pay him. Another way or another approach is just to make your CEO as one of the shareholders. This is very similar to what is called ESOP, Employee Stock Ownership Plan. So you're actually trying, I would say maybe it's better to say trying to make your CEO as one of the shareholders, as one of the owners, to make sure he's concerned as much as other shareholders. Again, this is not the kind of perfect solution, but in some cases it might work. So before wrapping up this section, so let me talk about another issue which you see with corporation. So when it comes to the business, when you are making money, you have to pay taxes to governments. That's a very common thing. So you are paying taxes, and so that's a revenue. The income you are making, that's a sales revenue, or so there are different terms. So just let's call it revenue, the money you're generating from your business. Then you are paying all the expenses, and then you need to pay taxes actually to the government. At the end, what is left, it's called net income. So that's net income, which you see at the end of at the end of income statement actually. So income statement, the last line is net income. That's the money which is left after paying out all the expenses, including the taxes. Now here is the problem. If you are the shareholder of the company, you might receive some money from that net income in the form of dividend, correct? So you receive some dividend. But for the dividend you receive from the company, you also need to pay taxes. The tax rate is usually much less than the corporation or corporate tax. However, it's some, so you need to pay for that. You see, there is a double taxation. This is already tax deducted, but also you need to pay as a shareholder another tax on the top of that. So this is called double taxation. Do you like it? For sure not. This is called double taxation. However, the good news is, one of the advantages of corporation is something we call interest tax shield. So let me talk about this for a few minutes, and then we are done for this lesson. So the idea here is that if we look at the very common income statement, so you have some revenue, you have some expenses, operating expenses. So you have your earnings before interest and taxes, EBIT, interest before earnings before interest and taxes. So this is your EBIT, your operating, sometimes called operating income, same concept. Then you need to pay interest to the bank or to debt holders. So whatever is left, it's your earnings before taxes. and then you need to pay taxes to the government, and this is your net income. Very simple form of income statement. For sure, there are many more lines in the income statement. Just make it very simple. Now, what's happening here? You see that you pay taxes to the government after paying out interest. Why this is good? Because the interest helps you to reduce the amount of taxes you are paying to the government. This is something we call tax shield. So the interest payment helps you to pay lower taxes. That's why we're saying interest works as a tax shield. To make it more simple, we call that ITS, or interest tax shield. We'll talk more about interest tax shield with an example, and I will be more specific about how it helps you to pay lower taxes, and we can calculate that in a more specific way. But for now, thank you very much. This is Ali Talabi. Have a wonderful day. Enjoy your time.